My apologies. I'm back. My apologies. All right. So we are going to do a quick session about A-shape, V-shapes manipulations. We'll wait for a little bit while people go online. All right. So as people go online, I'm gonna start right away. This video will be recorded and left published on the channel. It is gonna be about A-shape, V-shapes manipulations. It is what I personally like to look for in the market myself. I'm not a financial advisor. If you are new to this channel, you can subscribe, blah blah blah, all that YouTuber stuff, but I am not a YouTuber. I am just like you. So here we are, A-shape, V-shapes manipulations. Please use the chat if you have any questions. Lucas, what's happening, brother? All right, there's a V. Interesting, there's a V. But we have to continue with the trend. We have to go with the trend. This is an A, here's another A. Okay, and this is a very visual thing, by the way. I'm a very visual learner, so I just spotted for this one day. I remember I was looking at, like, I just wanted to know what happens at the moment in which price reverses. What happens at, how come price stopped right there and it continued falling, for example. So I'm going to quickly change my cursor so that you can see better where I'm pointing right there. Okay. So yeah, I was looking at the market one day and I said to myself, like, man, what does one have to do to buy, for example, right at that lower area? Or what does one have to do to sell right at that top? How can I do that? Because you just naturally want to you want the best, and you want everything, right? So that's what I did. I tried to figure out what the heck goes on and how I could trade it, what I had to look for, okay? And I ended up saying and realizing this is the market creates A shapes and V shapes. Literally, it does a symmetrical V and A when it manipulates stop orders. And after the A or after the V, there are also some things that I like to look for, and those are the things that I'm going to show you right now. But I'm going to write down a few rules, very simple. And if you have a notebook, it'll be nice for you to write these down as well. But for the A-shape manipulation, I'm going to look for them during downtrends. or before a bearish day or move. Okay. And then the V shape, obviously, I'm going to look for it during uptrends or before a bullish day or move. Notice I'm saying move. It doesn't mean it's going to occur throughout the whole day. It can happen, but you will see that it's not always the whole day, depending on the time frame. So we got these A shapes during downtrends or before a bearish day or move, and the V shape. What we have in common between them, okay, something in common in between them, is that they will be spotted within higher time frame areas of interest. This could be an imbalance or above equal highs or below equal lows. Okay? This is what you must be writing down. So we got A shapes that are going to occur as the market comes down because the market has to go up in order to come down. And V shapes when the market is going up because it must come down in order to go up. That being said, I'm going to illustrate it real quickly. We have the market going on uptrend. It consolidates and is going to leave a V shape manipulation before continuing the trend. Okay, so there is the V shape during the uptrend. During a downtrend, the market is going to consolidate and then create an A shape to continue its drop. And that is the A shape right there. Okay. And then that formation is going to happen below the V shape, below equal lows, or within an area of interest in the past. Okay. So for example, here we're going to look for something as well that is going to serve for the V shape to bounce off of and move it and create its move. It could be, for example, a previous low. And then over here, notice how this case was a little different, but it's the same thing. There you got two highs. You got that peak up over there that is occurring, and there has to be something around here that's interesting for the market to grab liquidity and continue falling. Okay, so that's the general idea. That's the simplest way I can present it to you, and we'll look for into the details. So here we have the V's. And here we have the A's. Okay. So you can take a photo of that or whatever. This is going to be recorded anyway. So, okay. So that being said, let's go out to the 4-hour time frame, because that is what we're going to do. We're going to map out the market. So let's go in the past. Let's not worry about what's happening right now. Let's start from the over here where the market started coming up. Okay. So when it was consolidating, I have right now two examples of A's and a few examples of B's. You can look for these in any time frame, but they're very effective in the 15-minute time frame. And obviously, if you see them in a on the daily or the weekly charts. But most of us are day traders, we're scalpers, we like to go in and out of the market. We don't want to hold a trade for a few weeks or a few days. So the 4-hour time frame is only going to help us to illustrate areas of interest where we could spot A shapes and V shapes in lower time frames, like the 5-minute or the 1-minute. Okay? So, for example, let's take this area right here that's got these two highs, and let's extend that rectangle to the right. So I'm taking all of this area from the body of this candle, the wicks, and then right here where the market stopped. So there's a wick right there. Okay. This is the 4-hour time frame. I'm going all the way back to November. When the market was consolidated, I'm taking the body of this candle and the wick of this one. So all of this range, all of this is a strong resistance. And it's a strong resistance because here the market used this area as a support. When it broke it, it retested once, it failed, it dropped significantly, it came back to it, it failed to break it more than this, and it dropped back down. So that is interesting. That serves as a lot of liquidity for the market to eventually come and test. Okay, there's a V shape, by the way. Look at the V shape right here. That's another example we're going to look at. But I'm focused now on this wick. Okay, look at that wick right there. You see that? That's a 4-hour wick, but in the 30-minute and 15-minute, that is not just a wick. Those are a few candles that go up and down, leaving an A. Okay, and notice how that's happening above these highs, and as soon as the market penetrates that level, it trades back down and it closes below that level with candles, bearish candles, closing below previous candles. So we're going to look at the lower time frame soon, and I'm going to show you that. But before going there, notice that that same candle did not close above the wick of this one. Okay, it did not close above the wick of that one. It closed below it. It not only closed below the level of this wick, it closed below this candle right here. You see that? Below the low of this candle and the body of that candle. That tells you a lot. It doesn't say everything yet, but it tells you a lot. The confirmation of this manipulation is this bearish candle that is now violating the bodies of these 3, 4, 5 candles. This bearish candle, it's failing to retest or to bounce at these levels. So notice how this wick served for the market. I'm going to change my cursor now because it's getting confusing with the wicks. So notice how this wick right here went below these ones, but the candle, the body closed above it. That's why this next candle, it retests that area again and it bounces. And now it closes bullish. But at the same time, there is already rejection here. So that's why these candles are not bullish like this one. What happens eventually is what this candle does. It will break all of that structure. It will completely switch and change the way that money and orders are now being delivered. It is not an up direction anymore. It is a down direction now. And there are two things that I'm looking at this chart that's telling me that is going down. Not only is the wick, but is this full body bearish candle again that is closing below these levels. That's it. That's what I'm waiting for. If you look at this in the 1 minute time frame, it's the same thing. 5 minute, 15 minute, 30 minute, 1 hour, 4 hours. We're at the 4 hours. Again, we're going to go in deeper and look at this wick, and you're going to see it, and it's going to be beautiful. Now, before we get there, this candle serves as confirmation. This one and this one follow that push. And then notice how the market is leaving empty spaces between previous candles. You see, the market always has to balance itself. If there's a high and a low and a new high, this previous high it should get balanced with a new low near that level to continue going up efficiently in a fair manner where both sellers and buyers are satisfied with the price they're meeting on. Okay? Whenever that doesn't happen, and whenever the market moves with strength and it fails to come back significantly, that empty area, it's called the imbalance. And what that does is eventually the market comes back to retest those empty areas and then bounces away, or vice versa to the downside. So with these empty areas, eventually the market will get there. And as you see it fall and create those empty spaces, they serve as future target areas. Because look, for example, here's an example to the upside. We have this area. If we don't look at what happened with this candle and we're looking at here, just do those two candles, right? On the right of my screen. We see that big candle, another big candle, there's an empty space. The market keeps going up, it leaves another empty space. Look at what the next candle does. It goes to fill those empty spaces and then it bounces from it strongly. You see that? So that is where the market is balanced. It's fair and squared, and so it moves on. These areas are still empty over here on my right. You see that? There's no candles yet. So all of this in the future, whenever the market decides to come back up, is going to test it. Okay? So what does that mean, those empty areas? It's volume. It's speed of the market is trading hard. There's a lot of sellers in this example, but not a lot of retail sellers. Those are institutional sellers that have a lot of money that are able to dump the market and make a significant change in the price. This could be a very big area where buyers had their take profit levels, and when we talk about orders and stop orders, take profit and stop loss, there are stop orders. A take profit on a long position is a sell limit. Okay? And then stop loss on a long position is a sell stop. Same example to the downside. When you're selling and you have a take profit, you want price to fall down and close at a take profit. What does that order represent? It's a buy limit. So I'm selling and I want to buy lower, and I'm going to put an order to buy at that price. If I'm selling and I want to protect myself, what I put? A stop loss, and that is represented by a buy stop. So whenever the market reaches these areas and it changes direction, is because at that point the market has gotten all of the liquidity from these mixture of orders that are protecting traders or allowing them to step out of the market with profit, and so on. That's like the peak of the iceberg, because to this there's also algorithms. I don't want to get too deep into algorithms, but they are the ones that actually move the market, and they create the opportunities for bigger money and smarter money to trade against retail traders that don't necessarily understand fully how to navigate the market, but mostly because many of them do know what they could be doing or should be doing, but mainly because they might not be experienced handling themselves emotionally. So they chase the market, they go in late, they close early, so they don't want to miss the next move, and so when they go in, they lose, and so that's actually one of the main reasons why people lose. Not necessarily because they don't know what's gonna happen or they don't have an idea what the hell they're doing. It's just that it's not. This is not the easiest job in the world. If it was, everybody would be rich and millionaires. So let's get deeper now into the wick, shall we? 15-minute. Let's go to the 30-minute before that. Let's just go to the 30-minute, and I always have to do this because you get lost. There it is. The 30-minute now doesn't actually look too much like an A, but you see the peak. You see this push up and then a strong sell-off, a strong candle going down. You see that? And look at the empty spaces I was talking about. From there to that, the market filled it, and then it's almost as if the market has its own mind and voice, and it can talk to you, and it says, okay, I'm dropping, I'm going hard. Oh, wait, hold on, never mind, I forgot to fill that empty space. Let me just get to that point, and then we're going. Okay, if we go to the 5-minute, now we're gonna see what happened with these candles right there, because the 5-minute might be able to show us a more clear picture of how that was, if I can get there again in the 5-minute time frame. I don't think I can. Nope. I need a premium. I do have a premium plan, but I need even a more premium plan. Well, let's just study another time frame, another example. I know you saw that one clearly. Look at this one. Look at this A right there. You see that's perfect, symmetrical. Literally, wherever the push up starts is where the push down also sort of stops and ends. And so you've got that push up to manipulate above these highs, and then the market closing hard again with volume and strength. Now, why is that? So what's happening is the market is broken. This high right there is tested again and is bouncing again hard. So it's giving the idea that is going to continue going higher. So you have trapped buyers here that are attempting to buy the breakout of a resistance, because that's what the textbook says. And that's what you're supposed to be doing, right? Apparently, but it's all a lie. And as soon as this area breaks, the market decides to start selling as well, hard. Another reason for this is when sellers come in here, looking at this movement and then this fall down hard, they are emotional traders who believe that this move is going to be strong and that they're going to get missed out. So they say, oh God, it's falling, hurry up, let's sell. So they probably sell here, and where do they put their stop loss? Just above that high. And they had their take profit maybe somewhere below these lows. And that's a great trade, but they got manipulated. The market goes up, it takes them out, and then it comes hard. It comes down hard with strength and volume, and that is institutional money. And we know this because it also leaves this empty space right there, that imbalance. Okay. Yes, the market did so as well over here. It tested it. It bounced back down. So this was a proper trap right there. This was a proper manipulation that goes against that principle. And when you see that, you could have, you could feel a bit more secure with the idea that that was a manipulation, and it should then distribute as it showed it was going to do it in the first place. Eventually, that's what happens here with the market. It opens with a gap the next day, and it continues that distribution of all these orders that it got manipulated out over here and sold hard. Okay. Here is another example. We have this high. that the market went to test. And when it was there, you see that peak. This doesn't look that symmetrical, but there is your A right here. Goes up and then down with strength, leaving those empty spaces after having tested these equal highs. It's right there. It's always there. Two highs or a few highs that the market goes for. Okay? Right there. Market trades into this area and then strongly bounces down, closing below the lows of these candles, the highs of these candles, I'm sorry, and breaking all of these support areas where the market had previously tested as a bounce. You see that? So these are the breakout of these structures, and eventually it keeps doing so. It keeps breaking, and it keeps breaking these support areas. And whenever you see the market break those support areas and then stop and create wicks, rejection wicks within that range, it helps you to feel confident that it is still going to come down. Okay? We would have to see rejection back above that level within that range. Okay? And that's eventually what happened. Let's study a V shape. A V shape right here. But that's not the sort of V shape. This is the sort of V shape I want to show you. Look at that one. 5-minute time frame. This is an awesome V shape. Because these V's, they come, you can see them after the market has been consolidated. And there's a principle that always takes place. And that is, the market consolidates. It creates a manipulation either up or above or below the area of consolidation. And if and when the market closes back inside the range it manipulated, it's very likely that it will distribute to the opposite side. Consolidation, manipulation, distribution. This is the consolidation. That V shape is the manipulation. And then you have that strong distribution. Okay, you see that? So the market does this before it wants to go up, it creates a V, and before it wants to come down, it creates an A. You have a consolidation here, which was this smaller range, manipulation, distribution. It's not always that pretty, that evident visually, but it takes place all the time. And what I learned to spot, and what I like to wait and look and see if it takes place, is for the support of that range, that it was consolidating in. You see, so this is the range, but I focus on the support. My eyes are looking at the support, because whenever the market breaks the support, I want to see if it bounces at any point. I don't care where it could go. But if I start seeing candles closing back up with a lot of strength and then closing above the support again, that's the V. There is your manipulation. You can buy safely because you are hopping in with all of the institutional flow of orders and money that got poured in, and also the algorithms that bought at this level in this specific example I'm showing you. Okay? Now, why did the market bounce exactly at that point? You know what? Because it wanted to, and it could. Because it got to this area where it was consolidated before, It broke out, or it started a push, consolidated, manipulated, and it bounced up. I'm not gonna tell you, oh, because that was a whatever level. No, I'm not gonna make anything up right now. It just happened to bounce at that level, and it just created a V shape. That's what I care. That's the only thing I look for. And the only thing I can explain to you is that whenever the market does this, that's what happens. Okay. What I want to look for after the V shape is for the same support area to be respected, hopefully even higher, like this example. So in this example, the resistance of the range, notice how the market traded back to it, but it held. It didn't return, it didn't reject with strength how it did here. It just stopped. It was accumulating. It is now accumulating. And then there's going to be a big breakout in distribution. So let's look for another example. Right here, check that out. It's not a perfect V, but you have equal lows that the market closes below and then closes back above. You see that? There was a long retest of that low, but the same candle that retested all the way down there closed bullish. Right here. I'm zoomed out because it's easier to see when you're zoomed out. But these are the candles that tell you the story. Okay? So I'm going to go zoom out, and so that you can see a little bit better the V right there. You see the V? And notice what happens with the resistance when the market breaks that resistance of the consolidation area. It serves as a support with the bodies. Look at the bodies. You see? Look at the bodies. Look at these bodies right there. Those bodies in relation to these ones. The wicks, of course, the wicks are outside of those ranges. But that's good as well. I want to see those wicks below that low for a rejection to the upside. Or I want to see a wick above that high for a rejection to the downside. You see? Okay, and then this example as well. So the market, after it retested a few times, this candle confirms it wants to go up. Yet another intention to break down here, but this candle closing bullish above these ones also tells us I'm bouncing. This is it. This is my floor. This is my support. Right there. The bodies respect each other perfectly whenever it's telling you that it wants to go up or down respectively. Okay? Question, is this an A? Yes. Are we going to look for A's right here? No. Why? Because we're trending up. I'm looking for that. Look at that V shape right there. That's a perfect V shape. That's beautiful. You see that? And where is it? Look again, my eyes. Where are my eyes? Look at those lows. And also look, all of that area. Look, all of that area. Even if I go to the wicks, I grab all of this, that wick goes below all that area. You see that? And it closes back above with strength. That's it. That's it. That's what I want to see. Could you have sold up here? Yeah, maybe in the 1 minute you see an A, and then you could do that. You could do that at a micro level. So the market goes up, above this high, A shape, down with strength. That's a fair trade. Those are a few hundred pips. Well, yeah, because it's 0.500. But yeah, you could do that. Again, the trend is your friend. So the bigger move, the more institutional, and the true volume is going to be on that push up after the manipulation of these lows. So that's the 5-minute time frame. Imagine like the 1 minute, it's even more evident, that V. But I know you're starting to get it and see it. So again, the V starts right there, and notice that it respects it. The price respects it. The V starts here. Down, up, symmetrical. When the up closes above the area that it started coming down, that area should hold as a support. Could it trade lower? Yes, maybe it leaves a long wick, but the bodies should not be closing back below this area. Not anymore. If it does, then it's not a V. It's not a valid V. It's just, a drop, a retest, and it's going to drop again. But this is the behavior you want to see. And then watch, look at the body of these candles. Look at that. You see that? So after seeing the V and after seeing that breakout, you could have either added positions here, or if you're not sure and you want to wait for a confirmation, because, to me, the confirmation is the V itself, this candle. But some people might feel a bit more secure when they actually see that it does respect supports. So this is one support, this is another support. This is your like triple confirmation. Like I would be holding a trade from down here, or if I missed it, then I'm closing my eyes and I'm just buying because I know that the V took place and this support is holding, so I know there's still room to go up to test these highs. And it does so very strongly because that's the trend. Okay? So that's your V right there. Market keeps going all the way up. All the way up. Look, here's an A. Here's an interesting A that happens above all this area. Market goes up and then trades below it. And then boom, it falls a little bit. But again, look at this sort of V right there too. You see that? And that happens below these lows. That little wick right there in the 1 minute, I'm sure that you could see it a bit clearer, more clear. And then again, look at that. That same area should hold as future support. And as the resistance of that V shape gets broken, it should respect as support as well. And we move. There's another A right there. Look at this A. We have from here to there and from there to here. So we mark that area. That's the A. This is a retest. That was a dirty move. You see? And there's another A right there. And it collapsed hard. So you could anticipate those drops as well. Okay? These wicks. This wick is a 5 minute. Maybe the 1 minute only shows like 2 candles up and down or something like that. Maybe 3. But it's the same principle. There are even highs. The market already fell with strength. So it stops, consolidates, manipulates, falls hard. The same way I've been showing you the V's. Here are this is an A hidden in a wick. If you go to the 1 minute and the 30-second time frame, that's a perfect A. Or maybe not perfect, but it's you get it. It's up and down strong. And it happens above the highs, trades down, and as the support areas of that zone, of that range get broken, they serve as a re-entry opportunity, as a pullback to accumulate or distribute in this case, and then continues. Okay? Another sort of V right there below these two highs. This is it. You see that? I'm not making it up, and it's there. Always even lows, even highs, even lows. It comes out of it and then trades back inside. Again, it's not a beautiful V, but you get it. When you see the candles closing back above each other, they're not respecting the same structure that they should be respecting. And as they break those levels again, so this candle was the confirmation, this big one, and then this one was like, the triple, double, XL confirmation signal that's like, yo, something is happening. This is abnormal volume. These are now retail. And then look what happens with the empty space between those candles. The market tests it, it fills it in, and it bounces hard up. Back to the areas it was before. Back to the areas it was at before. You see that? It goes back to the areas where it was before. You see that? So there's your trades. That's it. Just wait for the market to fall. Let it fall. Let it fall. Let it reach wherever it has to reach. It honestly sometimes doesn't even matter where it's gonna get. But eventually, that's all you have to wait for. Equal lows to get tested, broken, and then close back with strength above them. Or equal highs to get tested and then close with strength back below them. And you will be hopping in very strong moves that are going to be very profitable. Look at it right there. A, drop hard. V, look at this V. Oh, that's a beautiful V. This is a beautiful V right there. Look at it. V shape. Support gets retested, respected, boom, respected, boom, and it just goes out. It leaves the park. Support. I extend it to my right. It gets broken. Trades back above it. And now the support there was these wicks right here. Look at it. You see those wicks? This is the 5 minute, but the 1 minute, those are candles. And if I extend it to my right, the wick tested that wick. And it bounced again and it broke these bodies right there. And look at the next ones. You see that? That's all you need. You don't need indicators. You don't need nothing. You just look and listen to the market. Observe it. Watch it. It's telling you what it wants to do. It took liquidity below these lows at a very low price. It closed back with strength. As it tried coming down again, it failed to go lower. And then a big candle said, yep, this is my new support. Boom, closing above these highs. So there's your comfort. There's your triple premium XL, triple size, oversized, whatever you call it, signal confirmation. Like, you can't miss this. This is out, breaking all these candles, retest. Market breaks these highs. It retests this area again. Look at it perfectly. And then it's gone. And as it breaks those candles, it serves as future support areas. And what you can do with these levels is, as you're holding your trade, that's what you want to see. You want to see the market break previous highs and use those as a trampoline, as a support, as a new stair. And vice versa. If it's trading down and you see break a few candles that were bullish before, when they break them, you want to see price retest them and then fail to break them again to the upside and then continue falling. That's how you manage your trade in this scenario. Until you see, in this case, for example, until you see a big candle closing back below previous, then you can close. Because, oh, wait, maybe now the market wants to retrace. And we don't want that. We don't want it to retrace back to where we got our trade, because then what the hell did we do? We didn't do anything. We wasted time and we didn't take our money. So this can also help you to know how to manage your trade, when to come in, when to get out. Okay? And obviously, as you see price respecting these levels, you move your stop loss and you put it right below those lows, right below those lows, right below those lows, because eventually you know it's going to get taken out. But ideally, you just want to get out at the maximum top right after a big push, or whenever you reach your goal. If you want to win $50 a day and you got $50 a day, you close. You actually don't need more. As you get more money and more money, the $50 will turn into $100 and so on. Look at this example over here. Support area. This long drop and long up. That's a strong V, interesting V. You see that? So now I can answer a question like, isn't it crazy to buy there because it's like at all-time highs or it's super expensive? Like, well, not really. Let's define what's expensive right now. Like, define expensive. It's especially with gold. Like, gold is going to move how it wants to move, period. And it's showing you that it's moving upward. So just buy it until it proves you wrong. That's it. It's not about being right or wrong, but it's until what you think is going to happen doesn't happen. Okay? And it's that simple. Here's a A. Look at that A. is the 5 minutes. So these are 5 minute, 5 1 minute candles, 5 1 minute candles. That is a perfect A. After that, you could sell, because it doesn't matter if it's gonna, where it's gonna go. You know for a fact that you have this margin of error. If you sell here, you know that's your stop loss, and your take profit, you can just go with the market. You don't know where it's gonna fall, but at least you know it's highly probable for it to try to fall some portion of the up move. And well, you could also extend your levels. You know this was a previous high that it hasn't gotten retested. You see, so if you're here, this is empty. This space here is empty. It's empty. There's no wicks. There's no candles. So look, it's all empty. So whenever the market tries to come back, is going to retest and fill that empty space eventually. You see that? And so there's another V shape. So if you sold here and you see those candles closing back above the bodies of these ones, then you can close the trade. And then you can try maybe, or if you didn't sell and you're looking at this now, the V shape, there's your V shape again. You know you're supposed to buy. And what are you going to target? That high. And it takes it out and it comes back down and blah blah blah. Okay? All right, guys. This is it. V shapes, A shapes. It's not rocket science. I'm not showing you anything in regards to the sessions, but you could add the factor of time to it, which is very powerful. But I don't want to get too deep into this. I wanted to do a sort of quick session about this because it's that simple. I want to keep it simple. I want to keep it powerful. There's an A right there, above equal highs, closing back below them. Boom. You can test the other sides of the market where it started. So there's a V shape. Look at that V shape. Poof. That's a big V shape, and then boom, it went up. So yeah, you get the picture. That's an A. That's interesting. But the market is trending up. So I'm looking at this V right there. Look at that. 5 minutes. Again, these are 5 1 minute candles, 5 1 minute candles. That is a perfect V under 2 lows. That when my market closes, it tests those lows and it goes out. You could have hold those. Oh, it's powerful. I love this. All right. I hope you enjoyed this video. If you have any questions, use the chat or message me on my Instagram, or whenever. If you're new, subscribe, like, share, all that YouTuber stuff. But I'm not a YouTuber, guys. I just like to day trade gold and teach people what I know. So if you like this, comment, share it, subscribe, do whatever you want, blah, blah, blah. Enjoy your trading. Take care. Peace. Bye, bye. Hasta la vista. Hasta la vista. Let's do it.